Hello, everyone. I'm Matt Clark, research analyst with Money and Markets, here with your Bull and the Bear podcast. Now, if you aren't already, I do want to make sure you are subscribed to our YouTube channel. You'll find a lot of great new features out there with Chief Investment Strategist Adam O'Dell, Green Zone Fortunes co-editor Charles Sizemore, and myself each and every week. Now, we've created a new membership program for our channel as well. It gives you exclusive market information in the cannabis world, as well as stocks, interviews, news, and much, much more. And I want to make sure you're also checking out our website, moneyandmarkets.com, each and every day for safe, sound, smart, simple, profitable investment information for your portfolio. When you are on the website, do make sure you sign up for our free daily e-letter. In that, you'll get all that information sent to your inbox each and every day for free. Now, I want to move on with today's podcast. Today, I'm going to talk about hedging your portfolio using gold or Bitcoin. And I'm also going to go over our recent YouTube poll. But first, I want to talk about hedging. Now, for decades, seasoned investors use gold as a means to hedge against potential market downturns and inflation and things like that. It was very much a safe haven play, and it still is. And the biggest reason for this is because gold doesn't have any credit or default risks, and gold holds intrinsic value because of its limited supply. So basically, if you want to protect your portfolio against market downside or a rise in inflation, you also held gold in some form or fashion, whether that was through a gold miner, gold mining stocks, maybe physical gold, or even gold rights holders that hold rights to mining rights to gold mines around the world. So any way like that, that's a good way to kind of hedge your bet against the market. Now, today, however, investors have added a new asset to the list of potential hedges, and that is cryptocurrency, and more specifically, Bitcoin. The reason is very similar to gold. Bitcoin and cryptocurrency has a limited supply. There's only about 21 million coins, I think, is the cap level for Bitcoin, and it can be viewed as an attractive investment when yields are at or near zero. But there's more to it than that, but I'm going to keep it simple for today's purposes. Now, if you follow cryptocurrency, you can see the types of returns Bitcoin can give investors. On January 1st of 2021, the price to buy one Bitcoin was $29,333 at the close. By April 15th, that's about 4.5 months later, Bitcoin shot up to $63,346. That's a 116% jump in asset price over that short amount of time. However, Bitcoin's price has fallen just as quickly as it rose. As of close of business on July 20th, Bitcoin was at $29,608 for one coin. That's only slightly higher than when the year started, and it's 53% down from that high in April. Now, the price of gold has also moved up and down, and we can see its movements are much tighter. The year started with gold at around $1,950 per troy ounce. By February, the price dropped to around $1,700 per troy ounce. Gold had another bump up in May and then back down again in late June. Now it started to rise slightly as investors continue to fear for the potential for inflation as well as new COVID variants and things like that. It has struck some fear in investors, and it's turning to gold as a safe haven, driving up the price. It stands now at just about 7% down from where it started at the beginning of the year. Now, while these moves seem volatile, gold's up and downs are separated by only about $250. Bitcoin, on the other hand, sees ups and downs with a difference in the thousands, almost in the tens of thousands of dollars, as we've seen this year. So it's very volatile compared to gold. Now, there's another telling chart that you can look at here, and that is the Bitcoin to gold ratio. Now, what this Bitcoin to gold ratio does is it takes the price of Bitcoin and divides it by the price of gold. And what this gives you is the number of ounces of gold it would take to buy just one Bitcoin. When the ratio is up, or when the chart shows up, it's good news for Bitcoin. It signals the cryptocurrency is outperforming gold. However, when the ratio is down, the opposite is true and suggests that gold is outperforming Bitcoin. Right now, we're seeing just that. The ratio has been falling since the end of June, indicating that gold is starting to strongly outperform Bitcoin. Now, while both assets are rare, there are more advantages to using gold as a traditional hedge against the market downturn and inflation. For one, gold has a stable system for trading, and it's also very hard to transfer fake gold. Bitcoin, on the other hand, it is very difficult to corrupt because it's based on complex algorithms and it's encrypted and decentralized, but its infrastructure is still a bit shaky. Also, more importantly, Bitcoin is considerably more volatile than gold. In 2018, the cryptocurrency reached a high of $20,000, only to drop to around $4,000 in the same year, while in 2020, Bitcoin has experienced a 300% gain in price, only to pare that back. So the volatility makes it more difficult to find good entry points for investors if you're looking for a true safe haven to get into and guard your portfolio. Now, it might be better to trade Bitcoin as a pure trade rather than invest in it because of that volatility. It makes for good short and medium term trades in terms of maybe getting gains that way, quick gains in a short period of time. But if you're looking for long-term hedging against your portfolio, I would lean more towards gold as a traditional safe haven because its moves aren't necessarily nearly as volatile. It's much more grounded, and it actually has real value assessed to it, whereas cryptocurrency is only based on the value. Its value is only based on who you're trading with, not so much. It's not grounded in anything like the dollar or anything like that. It's just kind of an amount assigned. So it's a good trade, not really a good necessarily long-term investment as a safe haven. So now I do want to take the time to take a look at our latest poll on YouTube. Last week, we asked you how you invest in the stock market. And this was in relation to a video I did last week on Robinhood's upcoming IPO. And the questions were, the answers were strictly kind of what type of service do you use to execute your trades? And at least 62% of you said that you use other online brokerages like Fidelity, Charles Schwab, TD Ameritrade, and the like. Robinhood only garnered about 39%. Only 3% use a financial advisor, and 5% of you actually said you're old school and you like to call your broker to execute your trades. In the comment section, Denny said, I use a financial advisor for 70% of my investment dollars because they've got better tools than I do and can watch the market more closely and react more quickly. I watch commission, but it has paid off. I also invest using E-Trade for about 30% for my education, the fun of it, and of course, the hope that I might hit a home run. That's actually not a bad strategy to have, Denny. I think that's probably pretty good. If you wanted to even use like an online brokerage like Fidelity or Charles Schwab for 50% of your trades and maybe a financial advisor for the other 50%, I think that would be good as well. But I think what the balance you have is pretty good and your rationale is pretty solid. Crazy Lee commented on YouTube and said Robinhood because it's easy to use. Well, that's true. However, I do want to remind you kind of the content of last week's podcast. Robinhood only has about $80 million in assets under management. Comparatively, E-Trade has about $600 million. TD Ameritrade has $1.3 billion, and Charles Schwab has $3.8 billion. Now, one of the biggest issues I have with Robinhood, though, is its payment for order flow revenue model. And this is basically where Robinhood gets to send trades to a larger firm to execute those trades and gets paid kind of a commission, basically, for the trades they send. And it makes Robinhood almost beholden to the larger firms they send the trades to, because if that larger firm says no, executing those trades are going to put us, the larger firm, in a very difficult financial position, they may tell Robinhood, nope, we're not going to execute those trades. And it's kind of an issue that was raised back when Robinhood halted trading of stocks like AMC Entertainment during its rise as a meme stock earlier this year. So just something to keep in mind. Do appreciate everyone who took part in our poll, and we do try to put those up every week. So make sure you check back here on our YouTube channel, on our community section for the questions that we're going to ask. Now, also make sure you check out our YouTube channel. Head over to youtube.com, search Money and Markets if you're not already there. Be sure to subscribe. You get notified each and every time we post up a new video. We've got new video series coming out all the time. Ask Adam Anything is where I get to sit down with Chief Investment Strategist Adam O'Dell and ask him any question that you have. Sometimes even questions that I have. I like to pick his brain, like to find out what's going on underneath the hood. So he's a good method to do that. Charles has a new video series I've just recently joined him on called Investing with Charles. And in that, I ask him questions about the economy, the broader market, and he gives you his very unique take. By the way, he is a graduate of the London School of Economics, only close in proximity to Johns Hopkins, my alma mater in terms of prestige, in my opinion, but it's subjective. But we do that each and every week as well, so I encourage you to check that out. We've also launched a new membership community on our channel. It gives you exclusive cannabis market-related content, so you can hit join down below and find out more about that, along with our marijuana market update, which I do every week here on YouTube. But our exclusive content includes interviews, company breakdowns, advanced insight into our cannabis watch list, and much, much more. All that is on our YouTube channel. Maybe you're watching on YouTube, you want to listen to the Bull and the Bear as a podcast, you can do that. Just head over to your favorite podcast syndicator like Apple Podcasts, Google Podcasts, Amazon, Spotify, iHeartRadio. There's a wealth of them. And make sure you subscribe and get alerted every time we release a new podcast. Leave a comment or review either on YouTube or on your favorite podcast syndicator. Love reading your feedback. Love to hear what you have to say. Maybe you've got some insight into the market. Maybe you've got a question. You can do that as well. You can email me at feedback@moneyandmarkets.com. We'll drop that email email address right down there. Any questions you might have for myself, for Adam O'Dell, for Charles Sizemore, for any of us, we are more than happy to take a look at those and get to those questions as soon as we can. Head over to moneymarkets.com, sign up for our free daily e-letter. We'll give you safe, sound, smart, simple, profitable investment information each and every day for your portfolio. Sign up for our free daily e-letter and get that information sent to your email for free. We've got a lot more coming up here on our YouTube channel and on our podcast. So make sure you keep it tuned and subscribe. Make sure you get notified every time we put out a new video. Until then, this is Money and Markets research analyst and host of the Bold and Bear podcast, the Marijuana Market Update, Matt Clark, wishing everyone safe trading.